Hi, and welcome to Tax Savings for Construction, Architecture, and Engineering Firms. I'm Jessica Chisholm from Huddleston Tax CPAs. Today we're going to talk about entity selection for your business, the auto deduction, meals and entertainment deduction, home office and who qualifies, deferring payroll taxes on owners as a tax planning method, and bonus depreciation in Section 179. When you start your business, you should really think hard about what type of entity you're going to be. When it comes to choosing the best entity for your business, there are several different choices. You could do sole proprietorship, LLC, partnership, C corporation, and S corporation. Sole proprietorship's the easiest to set up. You just get a business license with the state and you're ready to go. You just a separate schedule, Schedule C on your 1040, so no separate tax returns required. You do pay self-employment tax on 15.3% of your net profits. An LLC is a disregarded entity for tax purposes. You're automatically, if you're a single member LLC, taxed as a sole prop. If you're a multi-member LLC, you're taxed as a partnership. Or you can elect to be taxed as an S corporation, and I'll talk about S corporations in a minute. Partnerships are when there's two or more owners sharing profits and losses. Partnerships are flow-through entities, so there's no tax at the partnership level. The owners get K-1s and they report that tax on their 1040. If you're an active member and a partner, your net income is subject to that 15.3% of self-employment tax as well. C corporations are what people talk about when they're talking about double taxation of corporations. C corporation pays tax at the corporate level and then again on dividends distributed to owners. So dividends are not deductible on the C corp return, and then when they are given to the owners pay tax on them at their personal level. S corporations are flow-through entities. They can avoid they avoid that double taxation, and you can potentially save on self-employment tax. S corporation owners are required to pay themselves a reasonable wage so that the IRS is getting that Social Security and Medicare on their wage. And then whatever's left over in net income is not subject to self-employment tax, but you can still take out as a distribution. There's also new for 2018, the 20% pass-through deduction. So sole proprietorships, LLCs, partnerships, and S corporations potentially qualify for this deduction. It's a deduction on page 2 of your 1040. There are different qualifications as far as what industry you're in, how much you've paid in W-2 wages, what kind of property you own, etc. So you should contact your tax professional to see if you qualify for that 20% pass-through deduction. There's the auto deduction, which is important when you're driving around for business. So there's two different ways to deduct the auto expense, either using the standard mileage deduction or using the actual expense method. Standard mileage deduction for 2018 is 54.5 cents per mile. Business miles would include trips to see clients, trips to job sites, to the post office, the bank, office supply store, basically anywhere you drive for business. Business miles do not include trips from your home to your office, so no commuting miles. The exception for this is if your home office is your principal place of business, then every time you leave your home for business, it would be deductible. The actual expense method is based on the actual expenses used to operate your vehicle. So you would track not only your mileage, you still need to track your mileage, but also all the costs associated with your car. So gas, repairs, oil change, loan interest, tires, etc. You track the business miles to determine the business use to see what's deductible. And you need to remember that once you choose the actual expense method, you cannot switch back to the standard mileage. So the meals and entertainment deduction, there's some changes starting in 2018. Certain meals are still 50% deductible on your tax return. Starting in 2018, meals that are for the convenience of the employer are no longer 100% deductible, but are now 50% deductible. So it used to be that if your guys were on a job site and you needed to keep them there because you needed to keep them working or there wasn't food close by if they left, you could order food to be delivered to the job site and it was 100% deductible to you. Now it's only 50% deductible. Also starting in 2018, business entertainment is no longer deductible. So if you used to take clients to baseball games, things like that, no longer deductible at all. For the meals to be deductible, you need to be conducting a legitimate business discussion. You need to be able to answer the following questions. Who was entertained? Where did the meal take place? When did it take place? Why? And how much did it cost? So a good thing to do is just grab the receipt at the end of the night, flip it over, write who you were talking to and what you were talking about, and keep that in case you're audited. The home office deduction. So in order for you to qualify to have a home office, your office must meet one requirements. So just one of them, not all of them. Must be your principal place of business, a place where you meet clients, an office that's a separate structure not attached to your house, or a place where you store inventory. So a big one for construction firms would be if you store inventory in your garage, or if you have a 100% work use truck that you store in your garage, then that space may be deductible. To calculate the deduction, the most often used method is the square footage method. So if you have a 2,500 square foot home and your home office is 500 square feet, your home office allocation is 20%. So it's deduction for 20% of everything to run your home: mortgage interest, property taxes, homeowners insurance, utilities, etc. You can also elect to use the simplified method, which allows you to deduct $5 for every square foot of your home office. This deduction is, however, capped at $1,500 a year, so you want to compare to see which method works best for you to get the biggest deduction. So there is a tax planning method for C Corps and S Corp owners to defer payroll taxes on the owners. If you're trying to maximize income in the current year and you want to defer some expenses into the next year, but you're on the cash basis, this is one way to do it. You'd pay a large percentage of the owner's salary at the end of the year, and then the payroll taxes aren't due until after the first of the next year. So you pay a big bonus in December, payroll taxes aren't due until January, you're deferring that expense into January and maximizing your income in the current year. This is something you can play around with. You can even do it the other way, where you pay the taxes in the current year to minimize income in the current year. So some people say, well, if I wait till the end of the year to pay most of my salary, what do I do the rest of the year to meet my cash flow needs? You can meet those using draws or loans to shareholders, and then you zero that out with the wage at the end of the year. Also, tax withholding on the salary is treated as paid evenly throughout the year, so you don't need to make quarterly tax payments as long as you're having enough federal withholding taken out of the salary at the end of the year. Another big one for for construction firms is depreciation on equipment. So large equipment is capitalized and depreciated over its useful life. However, an exception to that is that you could take bonus depreciation or Section 179 to expense those items faster. The 2018 tax legislation changed bonus depreciation. It was expanded from a 50% deduction on only new assets to be a 100% deduction on new and used assets that have a depreciable recovery period of 20 years or less. Section 170, this has made it more similar to Section 179. Section 179 allows taxpayers to write off assets in the year of their purchase, and this is for new or used assets, and there's currently a limitation of $1 million. Also, with the tax legislation for 2018, Section 179 has been expanded to include certain depreciable tangible property used in connection with lodging and improvements to non-residential real property, such as roofs. So there can be some good tax planning that goes along with bonus depreciation in Section 179, when to take it, when not to take it. So that's an important thing to talk to your tax advisor about. So in conclusion, to maximize the tax savings of your business, there are many different things to consider. One of the first things to consider is what type of entity your business will be to maximize your tax savings, how you write off your assets through depreciation, whether or not you're going to utilize a home office, and when to time your write-offs. So it's important to consult your tax professional to make sure that you're getting the most out of your tax planning. So thank you for attending today, and have a great rest of your day.